Kia ora, and welcome to the CoreLogic Property Market Update for October 2019. There are a few signs of life in the property market in September, as we reported at the beginning of October, with a small lift in our house price index. This has since been backed up by the Rhines HPI, indicating a lift of 1.4% in September. This life was relatively broad-based, with 15 of the 18 largest areas experiencing a lift in property value over the month. The greatest strength was down south, with both Dunedin and Invercargill seeing values increase by 1.8% in September, taking their annual growth rates to 12.8% and 13.3% respectively. While real estate values are showing a subtle rise, we can't necessarily say the same for sales volumes. When we smooth the sales data to account for monthly volatility, we can see a minor drop in nationwide volumes over the last 3 months, compared to the same 3 months last year. And it's a bit of a mixed bag across the main centres. There are further signs of Auckland moving past its trough, and Hamilton has definitely sprung to life, but things aren't so rosy in Wellington. Low listings are no doubt continuing to play their part in limiting sales, but given values in Wellington City have not grown at all in the last 3 months, we are starting to question whether the boom times are over for those in the capital. Obviously, it's impossible to go into too much detail here, but I would suggest checking out the latest release of our Mapping the Market tool, where you can explore the annual performance of every suburb in the country at your own leisure. Scanning around Wellington, we can see only a limited few suburbs in town with any colour, denoting annual growth above 5%. However, throughout the Hutt and Porirua, yellow is the dominant colour, indicating double-digit growth over the last 12 months. We've previously discussed the impact unaffordability has played in Wellington City, with first home buyers especially adjusting their expectations and heading further out of town to get better value for their money. This is still the case, and with increases in insurance premiums becoming more common and well known, perhaps this is also starting to impact on the overall performance of the capital city market. As mentioned earlier though, the norm across the country is still for positive growth in the market. And with interest rates likely to remain low for the foreseeable future, our expectation is for that growth to continue. Our quarterly series of buyer activity is showing a lift in investor activity for the now complete Q3. This could be in response to reduced interest rate serviceability tests, as well as the lower rates themselves. An increase in speculative purchasing could cause some caution from the Reserve Bank if investor lending figures show a similar pattern over the next month. This puts a question mark over the potential for a loosening of the loan-to-value ratio limits when the Reserve Bank releases their next financial stability review on 27 November. This date is not to be confused with the next official cash rate review and monetary policy statement release on November 13. So it's shaping up as a big month for our central bank. Don't forget, they'll also publish their final decisions regarding the bank capital review before the year is out too. For our take on that and everything else property, make sure you keep across the Research and News tab at corelogic.co.nz. Our most imminent release is an update to our quarterly property market and economic report, arguably the most comprehensive review of the residential property market and associated drivers and challenges available. Mā te wā.